Welcome everybody who was able to join us live for the I Invest Deal Radar virtual briefing, featuring one of my friends and colleagues, John DeBellot.
Well said.
Okay, and he is going to talk to us today about a passive income opportunity called bond laddering, and specifically as related to Kenya. And so we are super excited. And John, I want to just say, John is a fountain of information. He is the founder and CEO of Diaspora Freedom Initiative, the education arm, but as a whole, I think it's the DeBellot group. What is it called, John?
Yeah.
Okay, yes. And so
There's DeBelllote Global.
DeBellot Global. And so I think that it is just it was one of those things when I heard the information, I was like, oh my goodness, I never thought about the fact that bond laddering could be a great passive income tool that kills two birds with one stone. One, it gives you local income so you can hedge against inflation if you're a person who's coming from another country. And then also you're not stuck, or just attached to one currency. You have now diversified and receiving multiple currencies. So I'm excited. I know that this information will be super helpful and impactful to the people who are able to join and to see the replay. So please, I want us all to give a wonderful virtual welcome to John, who will be our facilitator for today. Over to you, John.
Outstanding. Thank you, guys. I think there's an issue with my camera today, so I'm sorry you guys aren't able to see my face here. My camera's on, but I don't see my face. So if you see my
I
face,
don't
that's great.
I don't see your face either, but I'm going to um okay, I was thinking maybe I could request. Okay, no, because it's saying your
It's a
video is there.
it's the African networks. They're not
Right.
trying
The
to let us be
slow, but
great
right.
today.
That slow buffering. I definitely know about that. But
How about it?
when you request your um share screen, it should be a little bit easier.
Okay. Let's see here. Did you get that?
Yes, yes, and I was able to share. Did you get it back?
Yeah, it looks like it.
Okay. I'm going to go off now.
All right.
Welcome, Grace.
Let me go ahead and bring up the You know what I'm not seeing though? I'm not seeing the option to tell it what to share. That's interesting, isn't it? We're having technical difficulties, folks. Let me get this thing up on this screen here if I can. There we go. All
Okay.
right. All right. Are you seeing the slide?
Yes, sir.
That is absolutely the wrong slide, isn't it? Hold on one second.
Oh, that's the other one. Yeah.
Yeah. Let's
You need me to
see.
send you the other one?
No, I think I just pulled it up.
Okay,
Now let me
perfect.
just switch what I'm sharing. All right. All right. Are you seeing the right one now?
Yes, I am.
All right, awesome. So we are talking bond laddering in Kenya. Number one difference between the Kenyan style of bond laddering that we have engaged in versus what a lot of people traditionally call bond laddering is traditionally when people talk about bond laddering, they're talking about maturity laddering, right? So they're saying, all right, we're going to have one bond that, matures this year, and then another bond that matures next year, and then another bond that matures a year after that. And so they're laddering the maturity of the bonds. That's not what we're actually doing here in Kenya. What we're actually doing is we are laddering the coupons. So what we're trying to deal with is we're trying to deal with global volatility and really equity fatigue, right? Where you have all this equity, but you're still a bit cash poor. Any of you guys who are in real estate know exactly what I'm talking about. You got all this net worth, you got all this equity going, but you're super cash poor. What we've been able to do with the coupon laddering is make sure that there's a very predictable cash flow for a very predictable amount of time, right? Sometimes there's some overexposure to growth and then underexposure to income, which is a really, really nice, fluffy way of saying cash poor again, right? So your network can look great, but then you're missing the ability to take advantage of other ad hoc opportunities because of that cash poorness, right? So that's really what we're looking to overcome on this side. Because of that, it's definitely not like a day trader type of thing. It's not for people who are looking to maximize returns and get the highest return possible. It's really for people who want some sort of liquidity that is predictable. So cash flow predictability, right? The reason why we're looking at Kenya right now is because it's a tier two economy and it's approaching tier one. They're currently building or currently have plans in place and breaking ground on those plans to build a nuclear power plant. They have infrastructure reaching from one side of the country to the other, combining access to Uganda and Rwanda down to Tanzania via rail. So that is in the works now. They have one leg of that already completed, and they're completing a couple others. They have their national airline that they do own that is nationalized called Kenya Airways. So they do a lot of air freight and air cargo. And so there's a lot of infrastructure spending and infrastructure development happening in Kenya right now. It's the third largest economy in Africa, in sub-Saharan Africa. And so that's why we're really looking at it. The other reason is that the interest rates really help us battle break even currency fluctuations, right? So a lot of times when you're dealing with investing in treasuries and you're dealing with investing in treasuries in other countries, the currency fluctuation becomes a major concern, right? What happens when the tier two or even tier three economies currency takes a major hit, right? So there's a really, really simple formula for us that we look at for that, and we just call it the break even formula. And it's simply the Kenyan yield minus the U.S. risk free rate, which is what yield you would get in the U.S. if you had the same type of treasury, which is it's right around 4% right about now. The Kenyan yield is averaging right around 14%, so you have a 10-point buffer, right? So the Kenyan currency can take a 10-point hit and you would still be making the same thing you would with a US Treasury, right? But you have that consistent cash flow. Most of the folks that are really kind of focused on this and most of the target that are looking at this are either working their passport portfolios and they're working Kenya into that passport portfolio. So they're spending time here and they're leaving that money in an account here. We also have folks that are running short-term rental businesses, whether that be Airbnb, VRBO, so on and so forth, and they're using the cash flow as their runway, right? So any of you guys who have run any of those kinds of businesses know that you get the phone calls once a week that, the faucet broke, we need more toilet paper, that we need sheets, for the bed, blah, 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 blah. And there's this nickel and diming thing that happens for the first year or two until you get everything evened out. So a lot of clients that are moving into the market in that way are saying, listen, I don't want the phone calls. Let's just go ahead and set up, this bond ladder, and then, allow that cash to flow into either the trust account or the corporate account on a monthly basis. And then we'll allow that cash to act as the runway, so I can essentially turnkey this business and kind of walk away from it. Right. So those are the kind of use cases that we're seeing jumping into this the most. And then, of course, there's folks who are relocating to Kenya, and then they set up their bond ladder in such a way that they can actually live off the monthly coupon payments. And so they don't have to worry about having any kind of active employment in Kenya. And some folks, it's them sending like their kids to boarding school. Right. We have a lot of like Kenyans in the diaspora, and just other folks in the diaspora that feel as though the international schools in Kenya are safer than the schools that they might be dealing with in the West. And so again, they let that bond ladder pay for everything those kids might need, as far as their living expenses and dormitory expenses and all that, while they're in country. So those are a few of our use cases in that. It's for folks that are looking for income, really not trying to speculate, not looking for, big risk, big reward, just looking for very, very stable cash flow. This is what the laddering looks like for us. Like I said, we're actually laddering coupons, right? So what happens, excuse me, I've been under the weather. What happens here in Kenya is the bonds issue out their coupon payments twice a year. So it's semi-annually. So they take their ROI, they cut it in half, and they pay you half of it every 6 months. So the ladder typically consists of 6 tranches, right? So there are 6 rungs on the ladder, and these 6 rungs, you want to identify them strategically so that bond A pays out in January and July. Bond B pays out in February and August. Bond C pays out in March and September, April, October, May, November, June, December, right? And so you get these 2 payments 6 months apart. And so you need 6 bonds to have 12 payments a year, right? Right now, the lowest bond that we have seen in the last 3 years has been a ROI of 12%. The highest bond that we've seen in the last 3 years has been 18.4607%, which was last February's infrastructure bonds. Now, infrastructure bonds are the game changer. Last year, they only released 1 infrastructure bond. The year before that, they released 3, right? So infrastructure bonds are bonds that have a special status with the government that allows them to be 100% tax exempt, right? So it's 100% tax exemption on the coupon payment, 100% tax exemption on the principal purchase, right? So you're typically not paying anything on that at all, as far as your withholding tax is concerned, and no other taxes apply to it also, right? So there's not a capital gains tax, nothing like that. In Kenya, wherever your home country is, or wherever you're a tax citizen of, speak to your local tax professional on that level. But in Kenya, infrastructure bonds are 100% tax exempt. Now, your other bonds typically have a 10% withholding tax. There are times when like 30-year bonds might have a 15% withholding tax. But even the 30-year bonds that we saw last year, the Treasury chose to put a 10% withholding tax on them. And that is a final tax. So in the Kenyan tax system, that means 2 things. Number one, you don't have to add it back in on your tax return. So you could technically file a nil tax return, and that would be legally compliant. And number 2, there is no additional tax that comes after it, right? So it's a final tax. You get a withholding tax certificate that is sent to you, at the end of the year to prove all of that, and you're good to go. So very little tax compliance type nonsense, with this type of bond ladder They make it very, very easy, very investor friendly. All right, so it's making money based on the coupon income. That's what we've talked about the most right now. The duration control, they always release two bonds in every auction with Central Bank of Kenya. One has a lower duration, one has a higher duration, right? So in the last auction, there was one bond that had 13 years left on it, and another bond that had, I believe it was 21.8 years left on it. Those were reopens. That's why there was the point there, right? So those were bonds that had already come out before. They reopened them. So sometimes you get another bite at the apple if you miss one. And then you get the rest of the maturity on that bond. Okay. There's the maturity based investment, which we typically target maturity and we target ROI. So we target at least 10 years with most of our clients, even though that's not necessary. And we try to keep the ROI on the coupon payment above 10%, right? So 10% guaranteed coupon payment. And then you have your liquidity rhythm, which is something that we're building strategically. Again, you technically would not necessarily have to do that, but the whole point of laddering is to have that monthly kind of cash flow coming in and increase the cash flow on your books. All right. Oh, I see something in the chat. Let me just see if there's a question I need to answer.
You know what, John? I was thinking, as you were starting, like,
Uh-huh.
can you hear me?
Yes, I can.
Okay. So what I was thinking is that, so one of the questions that I would think maybe perhaps somebody with less understanding of like where this positions, like for even if they're like relocating and this is the first country
Mm-hmm.
they're in to relocate to, this bond laddering offers an opportunity for what aside from, I know it's passive income. I know it's basically
Mm-hmm.
gives you the start towards, even if you decided to do some type of citizenship by investment, it hedges. Is there anything else that we're missing? Like, because bond laddering for coupons is different than bond laddering for maybe share the verses.
Yeah. So
Okay.
bond laddering for maturity is essentially using treasuries as almost like CDs. So you're stacking, if you're bond laddering for maturity, you're just trying to essentially hedge against inflation. Typically, people who are bond laddering for maturity, they're trying to beat inflation. They got a bunch of money sitting off to the side. They've done all the other investments they're going to do, or they're older and they don't want to be risky and they're preparing to retire and they just want that every year something comes to maturity, right? So when a bond comes to maturity, you get all of the principal back, which that's still valid in this situation as well. But what we're laddering here are the actual monthly coupon payments, and the reason for that is with our firm in particular, the vast majority of our bond ladderers are relocatees who want to relocate and not work. So what they'll do is they'll relocate, they'll buy the bond ladder, they'll typically deal with our architecture firm and our general contractors and build a house. So they'll have a house built, and in our locations, there are no property taxes. The houses are off grid, so you don't have to have an electric bill, a sewage bill, or a water bill. You have your own borehole, you have your own biodigester. So you have no bills once you build the house other than your internet bill and your Netflix, right? So that's covered. You have your place to live, and you're just setting up your maintenance costs. And then if you're working towards dual citizenship, one of the downsides of having an ordinary residency permit, which is the only Kenyan permit that leads directly to dual citizenship, is that it doesn't come with a work permit. So you're technically not allowed to work anywhere inside of Kenya for the 7 years that you're waiting for citizenship, right? So the answer to a lot of our clients for that is to have the bond ladder going, and the bond ladder actually pays out enough that all of their needs are met and some of their wants, and they're good for about 10 years where they don't have to work at all. And then in that time frame, they would convert to citizenship and they'd be able to do whatever they want. right? So that's the overwhelming majority of our individuals. On the business side, it's that having that runway going where they'll set up, it's typically Airbnbs, but they'll set up a business and then their runway will be managed internally by the bond laddering. The other good thing that happens there is sometimes they can have a non-grantor trust do the bond laddering, right? So they can have an offshore non-grantor trust where they are not the trustee. There's a corporate trustee, and that corporate trustee sets up the bond ladder for them, and then the beneficiary might be the company, right? And so the company and the company is being paid out, and so the way that the trust vehicle that we utilize in Kenya works is every year per beneficiary you get 10 million in distributions that are tax exempt, right? So as a non-grantor trust, they can't necessarily touch the trust other than the trustee that they have formed in the beginning, and that trust is now kicking out those coupon notes tax exempt because it's within the 10 million per year, so it's kicking it out tax exempt to the Airbnb management company, and so that there's no tax event on that money, and then that money is being used to pay staff, buy materials, maintenance and upkeep, so on and so forth. So they've essentially turnkeyed their own Airbnb using the bond ladder, right? So because they're laddering the coupons instead of laddering maturity, they actually have a very predictable cash flow for the next X amount of years. We have some ladders where people have guaranteed cash flow for the next 25 years, right? So there's a set amount guaranteed by the government, unless there's a government, default, which would probably indicate a combat situation, right? So your risk, like as far as bonds are concerned, as far as treasury bonds are concerned, there are no corporate bonds that we expose anybody to in this particular setup. So as far as treasury bonds are concerned, your risk is simply treasury default if the money is being spent in country. There's an additional risk if you're trying to pull the money back out of country, which is the currency rate. So that's where we run that break even formula. All right, what would your treasury bond rate be in your country? And then what is the yield that you're getting in Kenya? And so the buffer is the difference. So if that currency were to change more than the buffer, you're now losing money, back home, and you could have just invested in a local bond instead of an offshore bond. So between the US and Kenya, the yield difference, the yield buffer currently is about 10%, which is significant. So and there's never been a 10% swing on the currency rate. So right now there's very little risk of seeing a 10% currency depreciation in 1 year against the US dollar. So that's the difference. And those are kind of the different use cases.
That was amazing. And then I wanted to say, make sure that we kind of place here on the record a bit, right? So with even if um things change over the course of the 20 years, and I don't think I said this to you, John, but I'll say here is that we do have a tool, right, that helps identify where to roll the currency over to a different currency, of course, depending on the country, so that
Mm-hmm.
you can it's almost like it just rolls through 4 or 5 different currencies and comes back how you want it, with the least amount of risk.
Mm,
We have a tool
that's
that
not bad at
that does
all.
that. Yeah. So we should probably talk about that offline, but yeah, we have a tool that does that. So you can like let's say the rand is like at its all-time high, and it works well with Kenya. We roll it there. It stays there for a little bit, and then we roll it to somewhere in Eastern Europe where it's a similar exchange rate. And then it moves to it can move to Belize or somewhere. You know what I'm saying? I'm just throwing anywhere out because
Right.
some of that doesn't make sense. But you understand what I'm saying? There's some
Well,
maybe somewhere in
absolutely.
South America, sits there for a little bit, and then you pull it into the US because it's the same. And so it may take a little bit longer for you to get it, but it comes out and you're
Right.
not taking a loss. And depending on how significant the loss could be. Because again, like your trust
Right.
structure, it may not even be worth all that. But for people who are looking for actual returns, and less on the protection, um,
Right.
it might be a good option. Just an FYI.
Yeah. Yeah, no, if you have like a forex arbitrage system, that's amazing. And that would definitely mitigate some of that risk for sure.
Yep,
There's always inflation risk, but that you have that with everything. So the inflation risk is the same. Um, and then
exactly.
yeah, there's sovereign default, but I personally don't see that as a significant risk at the moment. Things change at any point in time, right? As we're seeing with decisions being made by the U.S. government now, right? So I last year I would have told you that we wouldn't be trying to annex a territory in NATO, but look at where we are. So things change in sovereign decision making all the time. So it is still a real risk, just not anything that's on our radar at the moment. There's nothing that would indicate that there would be any sovereign default risks currently. So we're kind of getting into who this is for. We've been talking about this a lot. Income seeking, capital folks. This makes a lot of sense for. People who prioritize cash flow over capital appreciation. They're comfortable with known yields rather than uncertain upside. And they value predictable income schedules. Of course, this is not 100% of anyone's portfolio, right? It has its great uses, but it's not going to be the thing that turns into a whale or the thing that blows up, and takes your $10,000 investment and turns it into 20 million, right? It's not going to do that. Risk aware allocators understands and accepts currency risks, like we were just talking about. Has a diversified overall portfolio, right? People who are depending on this, with the exception of people who are living off of it for relocation, but people who are solely, depending on this, it normally loses its luster because it's boring. It's guaranteed income, and the income is the same every year after year after year, right? That's what it is, right? So if you don't have a diversified portfolio, or this is not something that you set and forget, and you're allowing those coupon payments to build in an account, in an offshore trust, then it's probably not going to be for you. Also, someone who can withstand short-term volatility for long-term income, right? That's going to make a lot of sense to those folks. Patient capital, multi-year investment horizons. We normally do a 7-year plus. So it's typically, our target is 10 years. Not dependent on the capital for liquidity, right? So the initial capital going in, the only way to make that liquid is to go to the secondary market. And on the secondary market, you almost always are going to lose. But you can liquefy those bonds on the secondary market. You can also try to go back and find specific interest rates that you want. Like if you really wanted that infrastructure bond, which is obviously a hot commodity, you could try to go back to the secondary market and find someone who has it, who's selling it. And then, of course, they would lose, and you would be able to pick up that tax exempt bond. So we've definitely, had folks that do things like that. And then focused on wealth preservation and income. Because what ends up happening is, if you're compounding in a generational wealth focused trust, for example, right? So you have a family trust that's focused not on yourself, but focused on compounding whatever initial capital you put into that trust, to create a trust fund for grandkids or kids over time, right? So you have this compounding goal. For example, you're trying to compound at 10% a year for the next 15 years, so that your kids can have $3.8 million when their trust starts distributing to them. By having these bonds kind of kick out this monthly fixed income into that trust, and then allowing your trustee company to follow whatever instructions are in your trust deed, as far as what percentages you want in real estate, what percentages you want in securities, what percentages you want in crypto, blah 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 blah. You're able to jumpstart that capitalization that's happening inside of that compounding account, right? Or inside that compounding trust, right? So rather than just waiting on all of the risky bets to pay off, you can make sure that you have this monthly flow of income coming from the initial capital. And then your trustees are taking that income, and maybe you have a 100% drip. So you have like a 100% dividend reinvestment plan. And that 100% dividend reinvestment plan is now following whatever your trust deed says as far as allocations are concerned into riskier investments and money market funds and IFTs and special funds and et cetera, et cetera, et cetera, right? So we see a bit of that as well in the generational wealth space. All right. Who should avoid this strategy? Short-term traders, absolutely. If you need short-term liquidity, this is not the move for you. So you want to stay away from that. Liquidity constrained investors, right? So capital in the bond ladder is committed until the end of each rung matures, and the maturities may be and will be different. We've never had a year where every single rung on the ladder was exactly the same amount of maturity. So they will be different. If you need the money unexpectedly, and we're not for like emergencies, but if you just unexpectedly like love to just jump into ad hoc decisions at a whim and need ad hoc, money, and this is going to constrain that, and so you're putting yourself in a position where you might go to the secondary market in order to, go after another opportunity, then this isn't going to be for you, because you're gonna cut your throat in the secondary market to go after that next thing. All right. Forex intolerant profiles. If any currency depreciation is unacceptable, local currency bonds are not suitable for you, right? So the yield premium compensates for forex risk, uh, but it does not eliminate it, right? So the forex risk is still there, but because there are yield premiums happening in Kenya, it does compensate for it, but it does not eliminate it by in any stretch of the imagination. However, we did just hear about Stephanie's tool that can arbitrage forex and mitigate a bit of that for you. So definitely something worth looking into. Maximum upside seekers. So you're blue chip junkies. If you're a blue chip junkie and you're a maximum upside seeker, and you're looking to take that real high risk and try to get that real high reward, bond laddering is not for you, right? So the bond laddering is an income infrastructure. It's not return maximized. So if your goal is aggressive capital growth, equities or the private markets are way more appropriate for you guys. All right. Definitely don't want the wrong folks, perhaps missing that this is not going to do that for them. This is really, really, really good. Think of this as like Gerber baby investing, right? This is really good for people who can wait, like super good for people who can be like, look, I'll come back in 18 years and see what's going on, right? Super good for that. In Kenya, your bond tranches can be as low as, what's the lowest I've ever seen, like 3 years. That was an infrastructure bond that had a really, really good rate, and it was only 3 years long, and can be as high as 30 years. All right. Typically, the ones that we're looking at, they're 10 or 15 years, somewhere in those neighborhoods, up to about 20. Okay. All right. Portfolio context. These are really other things that your portfolio could be consisting of. We won't get too deep into that. It's really its own discussion for another day. So strategy overview. All right. So your investor profile and your currency preference is definitely going to be part of your strategy, right? So you want a high level process. You want to make sure that you really understand yourself as an investor. If not, talk to your people, talk to the people that are managing your investments now. Get them to tell you unabashedly who you are as an investor. And if they won't, go to your tax planner or your tax attorney or whoever your tax person is and get them to tell you the truth about who you are as an investor. Build a solid investor profile. And then figure out your currency preference, especially if you're going to be working with Stephanie on the forex arbitrage, right? Because in that case, you can pick any currency you want. So make sure you take a look at the Kenyan shilling, how it works, how much it's pegged to the dollar, if at all, and what some of the kind of aspects of its currency are, right? So part of its currency and part of what it does, really, really well in Africa and really in the world, is it has a very strong digital currency platform that virtually everyone in the country uses. That I believe there's about 10 or 12 million transactions on that platform per day. So really, really robust digital currency platform, and that's part of the backbone of the economy here. So just things like that. Do your due diligence, of course. Um, Bond universe selection, right? So this is the Kenyan bond universe. There are other countries that have higher yields. So there are other countries in Africa that have higher yields as well. For our clients, our relocation clients, they typically don't make sense because they're not trying to relocate there. And even if they were, even though the yield is higher, the cost of living is higher. And so they can't live off of the yields, even though they're higher, right? So we have kind of like that sweet spot where the yield might be a point or two lower, but you can live off of those yields, for the maturity of the bond here because of the cost of living, right? Your ladder construction, the structure that we use is a six rungs structure. The reason why we use a six rung structure is because the bonds pay out every 6 months here. So you get two payments a year, 6 months apart, right? So if the bond universe that you selected was, say, Seychelles, last I invested in their bonds, it was annually. So you would need 12 bonds to have the same structure there because they don't pay out every 6 months. So in order to get a payment every month, you would need 12 bonds instead of six. All right. So your ladder construction is going to go back to the bond universe that you're working in. Your custody and your governance, what kind of frameworks you're going to be using. Are you using trusts? Are you using companies? Are you using IBCs, right? International business companies. They typically have a lower corporate tax rate as long as you don't do business in that country, things of that nature. Now, the reinvestment discipline is really on you, right? Because the protocol can be to allow the bond to do the reinvesting, right? So the coupons that are coming in, if you're using, a trust formation, or even in some cases, like a foundation or a operating foundation, then your trustees can then reinvest based on your protocol. So you can create the protocol and you can figure out how much how much of the maturing principal is being deployed, or how much of the coupon payments are being deployed into either new bonds or new securities, right? So if you're doing that, then it's not set it and forget it. It's systematic. If not, if you're living off of it, or you're pumping it directly into a business that you have set up, then it actually is set it and forget it. Any questions on that, Stephanie?
No, I just saw an opportunity to collab though, so we need to talk about it.
Uh, all right. All right. This is an actual case study. This is what happened with um all of our bond ladder clients from last year, all of the ones that are in the same tranche. There are two tranches. But this indicates the exact numbers. You can actually research these bonds. So if you're looking at the replay, or if you're here, want to take a screenshot or whatever, you can research all of these bonds. These are the actual bonds that were purchased for those clients. These are the coupon payments, or the coupon percentages for each of those bonds, and this shows whether it's taxable or not. This that says IFB here for the February, August, that is an infrastructure bond. So IFBs are the tax exempt ones, right? And you see that the coupon rate on that was 18.46%. To be more accurate, it was 18.4607%. And so the smallest bond here actually paid out 54,000 in the 2 months that it paid out, 54,000 local currency, right? Which 50,000 is our target, and 50,000 is enough to live off of completely as long as you own a home. If as long as you don't have a rent payment. If you have a rental payment, it's not enough. And so you can see that we exceeded that target for all of those clients. All of these clients are relocatees. So we exceeded that target. The average monthly cash flow for them was 67,903 Kenyan shillings, which is essentially $525 a month. Their net portfolio yield was 13.58%, right? That's after withholding tax. And so remember the Kenyan yield minus the U.S. risk-free rate. So the U.S. risk-free rate is about 4%. So there's about 13 and a half. I'm sorry, there's about 9.5 in buffer there that the currency could depreciate. But they are living in Kenya, so they don't particularly care about that break-even formula anymore. And so they're making an annual 814,835 Kenyan shillings a year. That's free and clear after all taxes, about $6,300 per year. And they are getting that for the next 8.5 years. One of the bonds falls off at that 8.5 point, which of course they will then turn around and reinvest. There's the two infrastructure bonds are typically your lighter bonds, and we make that exception on the 10 years for that. So they'll fall off because they have a smaller maturity. Then you see that May-November fixed dividend bond is 25 years. And then the April-October bond is 15 years. The September and March bond is 10 years, and that Jan-July bond is 30 years, right? So the majority of this ladder is going to be around for the next 10 years, which is our target. They're going to be replacing the two infrastructure bonds in 2028 and then again in 2032. And then that largest bond of theirs, they won't have to think about until 2041. So you can see this is a long-term safety play, essentially. All right. All right, the real world frictions. We've already talked about Forex and liquidity, tax and compliance considerations. So wherever you are a tax resident, or if you have a US passport, a North Korean passport, or an Eritrean passport, then by having those passports, you are going to be taxed by those countries. So you want to talk to wherever you're a tax resident, to your local tax professional in that place about what this might mean tax wise for you. Beyond that, all withholding taxes on bond interest is a final tax, so there is no additional filing required. Under the Tax Act, Section 11(3)(a), you are able to get 10 million annual limit per beneficiary for tax-free cash distributions, right? And there's an uncapped exemption for education, medical treatment, and early adulthood housing programs. Remember, we talked about people sending their kids to like top class boarding schools here. There are international boarding schools here that are pretty top notch. And so they'll send their kids in there and they'll use the trust. And so there's that 10 million annual limit just per beneficiary. However, with the specific type of trust that we utilize, there is an uncapped exemption for education, medical treatment, and early adulthood housing payments. So every single distribution for those boarding school students is 100% tax free. on this side. So that is a beautiful thing for those people who are doing the return to Kenya for boarding school situations. All right, market access realities for diaspora investors. So your opening Kenyan custody accounts requires an in-person or notarized documentation. Our firm typically takes care of that. You need a central depository system account. Our firm also takes care of that, but you need a CDS account in order to buy bonds in the first place. The banking relationships with Kenyan institutions involve the know your client processes that I'm sure you're all familiar with. And you may have ongoing reporting and compliance monitoring. And it wouldn't be optional for a lot of you. So if you guys are using the trust, what we found is that there are very few instances in which the local tax professionals and tax attorneys have told their client that it makes more sense for them to have a grantor trust and have all those crazy reporting and compliance IRS situation documents going than to have a non-grantor trust. But if you have a grantor trust, then you could manage the trust yourself and be trustee if you have the time to do such a thing. If you have a non-grantor trust, the trust is essentially going to operate on its own without your input. And it is a perpetual trust. You can definitely use it as a full-on dynasty trust, and it can last every generation that comes after you. And it has a very much reduced reporting and compliance platform compared to it being a grantor trust. Okay. So if you want to know more about that, please speak to your tax professionals or go to irs.gov if you're an American, and in the search bar, type in non-grantor trust. Why this matters for the diaspora, from emotional exposure to structured capital, right? So many of the diaspora investors have money at home driven by emotion, land purchases, family loans, speculative ventures. The bond laddering transforms that emotional exposure into structured income. The capital is still in Kenya, but now it works systemically, right? And so this is for people when we set up, we actually have programs for people who have not experienced investing before and do not have what most would consider wealth yet. And the purpose of that program is for them to create generational wealth and for them to be the catalyst that creates generational wealth in their family, because it's been very difficult as a community for us to do that because we don't have very many examples within our family unless we happen to come from a family that that has already broken through that barrier and doesn't need such a program. So for those people, we get them away from emotional exposure and get them into something structured. We also typically will do to start building families. Income with discipline, not in the off rather than returns. And so it asks, does the yield or so do your break even formula work for you? Does the make sense for your specific portfolio? If yes, then we proceed with discipline, right? And if no, then we deploy that capital elsewhere. We're really, really careful about that because we want to make sure that the person understands. It's almost like a syndication, that they understand that they're going into a primarily non-liquid investment, right? And that this is purely discipline based, and that there should be a goal for this cash flow as you move forward in this investment. Capital aligned with mobility and legacy. This really, 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 really aligns with compounding for legacy. So a lot of our trust fund people just eat this up, right? The bond ladder just makes all the sense in the world for them. And they're able to supercharge their compounding essentially with the bond ladder. So diaspora wealth often serves multiple purposes: current income, future optionality, family legacy, and the bond ladder provides predictable income while maintaining flexibility. It is a financial base that supports mobility rather than constraining it, right? So for that one, we create a foundation for future freedom, utilizing the bond ladder, and that's where you see those folks that end up relocating here and living off of the coupon payments, using the bonds as a foundation. And within a few months, they typically shore up their capital expenditures, and then their burn rate lowers a little bit, and then they take excess and they start investing in other things, so they start diversifying their portfolio from there. All right, I'll let you come back in, Stephanie, and talk a little bit about I invest role. I know you spoke a little bit about your forex arbitrage, which is awesome, and talk about any roles that you want the community to know about, as far as I invest and Diaspora Freedom Initiative kind of combining forces on anything here.
Sure. So, the number one thing that I would say is that we are and you will get into this later, John will be sharing the opportunity to buy into the bond laddering opportunity for those who who want to relocate and also generate local income. The other piece that I would say is that if you are a person who doesn't quite know where, what, how, when, why, we have something called the wealth diagnostic. And so I will follow up that the whole purpose of that diagnostic is for you to be able to take your information, put it in a local place, and it will analyze where you are in the wealth journey, wealth building journey. There's four particular stages. It'll tell you if you're at the beginning, at the growth phase, at the kind of diversification stage, and if you're at the legacy building stage, like at the point where you've achieved a mass and now it's kind of becoming institutional. You're making, you know, one decision, two decisions a year versus trying to make a decision every quarter of every year. And then it delivers kind of a 90-day blueprint that tells you exactly kind of what steps to take. Should you be calling John to get into Kenya? Should you be calling a different advisor to get into another country? How do you build the passport? Should you relocate? Do you need to cut your costs? How do you get to your goal? In order for you to do that, and the leveraging, the what we're calling tier two and tier three, or frontier and emerging markets. So that's I invest role. Obviously, you can always subscribe to the magazine, and that is really your entry point. It is the briefing room. It's not really a magazine in the sense of, we're just posting articles for the sake of it. It's a take action decision tool for people who don't really have a lot of time to go through a lot of changes. They just want to get right to it. What's the decision that I need to make? How can I make that decision as quickly as possible? Does the magazine or the media house have access to those people right away? And this DealRadar is an example of such. For people who want to relocate to Kenya, want to have I mean, it's all in one, right? You want to buy a house, you want to build a house, and you need local currency to sustain yourself while there. Then John obviously is the person that you need to be talking to, and that's the reason for the DealRadar briefing. So over to Diaspora Freedom Initiative role.
Outstanding. Yeah. So our package to execute on just the bond ladder is typically 75,000. Of course, we're behind you the whole way. It includes the scheduled strategy conversation, but with you the entire year, because it can take an entire year to get every rung of the ladder. So if we just buy the first 6 bonds, then 3 of those bonds might hit in the same month, right? So we have to find the bonds that are going to be for January, July, and we got to strategically get all that mapped out. And there's no list of what bonds are coming up next. So it is quite the adventure. But the package includes the full 6 bond ladder, um, all bond acquisitions and settlement coordinations. Your Kenyan custody account is set up. Trust fund formation and registration if necessary. Trustee drafting if you're going to do the trust fund, of course, and governance structuring, initial compliance and tax alignment. And that would be both on Kenyan side, and our tax professionals, are the Kenyan version of CPAs, would sit down with your tax professionals, whatever that might be, whether you're Canadian or UK or US, and we would get that all squared away. And then your reporting framework would be set up so that it's all ready to go from there on out. So that's what a full-on bond ladder looks like. The amount that you want the coupons to pay out could be adjusted. This particular bond ladder targets 10 years of maturity, and at least 50,000 in local currency per month. And as you saw from the report, in the case study, at no point in time has any of our clients actually gotten 50,000. They typically get more than that. Once we see our clients getting 50,000, that's when we know that the bond rates are correcting themselves, because these extraordinary ROI rates are not going to last forever. The reason that they're here now is because of the infrastructure that's taking place to catalyst Kenya from tier 2 to tier 1. Right. So once they're building a brand new international airport right now, they're building that nuclear power plant right now. When those things are done and all of the infrastructure things that they want to do are complete, their bonds are going to start drifting back down towards like USA Treasury bonds, 4%, 5%, 6%, nowhere near 18% like they are now. So as that starts happening and we start seeing that new people who are onboarding are actually getting the 50,000, which is still enough for them to live off of if they're relocating. But as we see that they're actually approaching those real numbers, that's when we got to take a step back and say, okay, this still works for trust funds. It still works for everything else. But once we get below 50,000, can someone not live on this anymore? Or what are we doing here? Right. So that's kind of a KPI for us, but we're nowhere near that at the moment. So that's great news. That means that hopefully we got another year or two of viability on this particular strategy moving forward. Now, for folks who want to come in and actually put a house up, it only costs 110,000 more for a 1,700 square foot home, 3 bedroom, 3.5 bath on your own land. You have your own water, you have your own biodigester, which is kind of like a septic system that doesn't need to be changed. The only thing that doesn't include is the solar package. So you're not energy independent. That's a different setup. But that is going on right now while we have land in inventory to be able to deliver that. When we don't have land in inventory, then we won't be able to keep that particular package price, because we don't know what it will actually cost to get the land. So the land is a standard 50 by 100 plots, 1/8 of an acre, with a 2-story, 1,700 square foot home that we build from the ground up for you, as well as immigration compliance and all the things on that list. So those are the 2 most used packages that we offer at the moment at Diaspora Freedom Initiative, and you would be able to go to our website at diasporaltd.com and engage with us there to get more information on that. All right. We got a what this is and what this is not breakdown over here. This is a governance first income strategy. This is not a yield chasing or return maximization strategy. This is designed for patient, sophisticated investors. This is not designed for speculation on currency, like Forex speculation or movement rates. This is designed for professional execution, from structuring through settlement. This is not a managed fund with assets under management-based fees. There are no fees attached to this. This has transparent pricing with no hidden fees. This is not a do-it-yourself toolkit or strictly educational product. This is an ongoing reporting and compliance support opportunity. This is not a mass market or retail oriented opportunity. So the opportunity will end, and it is limited engagement. All right, next steps. Join I Invest magazine. Definitely subscribe to the publication. Like Stephanie said, it is your entryway into all things investment, and all things wealth. All right. Access the One Thing community. Qualify for a strategy conversation. If you go to our website, you can take an assessment. So you can either take a relocation assessment, or you can take a wealth assessment, or you can even take a mergers and acquisition style assessment. And you can always schedule a consultation with us. So you can go to calendly.com/my-freedom in order to do that. So that's calendly.com/my-freedom, and connect with us. All right, that is it. There's the legal stuff on the screen. Educational content only. This is no personalized advice. Please talk to your own financial, legal, and tax advisors. Individual circumstances vary and require independent professional evaluation. Market conditions may always change. All market data, yields, rates, and projections are illustrative and based on conditions at the time of preparation. Actual results will vary based on market conditions at execution. Of course, past performance is not an indicator of future performance. All of the disclosures that you guys have all heard before. Right? Independent professional advice is required before making any investment decisions. Consult with a qualified financial advisor, tax professional, or legal counsel who can evaluate your specific situation and then take you to the next level.
And just like that.
And
Um,
that is it. So thank you guys.
Thank you so much, John, for this information. It was truly helpful. I do want to see, I believe that our attendees are busy. So if you have questions and you are watching the replay, please, by all means, just reply to the email or reach out and ask your question. I will leave inside the follow-up email the link to schedule your strategy call with John at the time of this email, and then you can take on the next steps from there. So thanks everybody for joining, and I hope you have a great day.
Thanks, guys. See you soon.